The dollar index just touched its lowest point since November 2021, settling at 95.86 this week. And if you understand what that number represents structurally, you're watching the unraveling of a monetary architecture that has underpinned global commerce, debt markets, and geopolitical power for more than 8 decades. This isn't a temporary dip or a correction within a healthy range. This is a breach of critical support levels that central banks, sovereign wealth funds, and institutional desks have been watching with increasing alarm since mid-2024. The question NPR and others are now asking, who wins and who loses from a weak dollar, is actually the wrong framing. The real question is why the world's reserve currency, backed by the largest economy and the most liquid capital markets on Earth, is experiencing sustained devaluation pressure at a moment when fiscal deficits are widening, geopolitical fractures are deepening, and alternative monetary frameworks are being built in real time by nations that collectively represent more than half of global GDP. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. The scale of what's happening right now is difficult to overstate. The dollar index, which measures the greenback against a basket of 6 major currencies, including the euro, yen, and pound, has fallen nearly 7% from its recent peak in late 2024. That might sound modest until you recognize that currency markets are measured in trillions of dollars of daily volume, and every percentage point move represents enormous shifts in purchasing power, debt servicing costs, and cross-border capital flows. A 4-year low isn't just a number. It's a signal that the marginal buyer of dollars, the entity or institution that steps in when everyone else is selling, is either absent or losing conviction. That's a structural problem, not a cyclical one. What's driving this isn't a single policy misstep or an isolated shock. It's the convergence of multiple systemic pressures that have been building for years and are now reaching critical mass simultaneously. Start with the fiscal position of the United States. The Congressional Budget Office projects federal deficits exceeding $2 trillion annually through the end of the decade, even under optimistic growth assumptions. The national debt now stands above $36 trillion, with net interest payments approaching $1 trillion per year, consuming roughly 15% of federal revenue. That's more than the defense budget, more than Medicare. It's a structural liability that grows automatically, compounding faster than GDP, and it creates a vicious cycle where higher rates increase the deficit, which requires more borrowing, which puts downward pressure on the currency. At the same time, the Federal Reserve finds itself in an impossible position. Inflation remains sticky above target, labor markets are tight, and core services, inflation is proving resistant to previous rate hikes. But the global economy is slowing, credit conditions are tightening, and regional banks are still nursing unrealized losses on bond portfolios underwater from the 2022-2023 tightening cycle. The Fed cannot raise rates aggressively without triggering financial instability. It cannot cut rates without stoking inflation and undermining dollar confidence. So it wavers, signals flexibility, and markets read that as a lack of resolve. That perception, whether fair or not, erodes the premium investors' demand to hold dollars. Now overlaid geopolitical fragmentation. The BRICS coalition, which recently expanded to include Saudi Arabia, the UAE, Egypt, Ethiopia, and Iran, represents a bloc actively working to reduce dollar dependency in trade settlement, reserve accumulation, and energy transactions. Saudi Arabia, the linchpin of the petrodollar system since 1974, has publicly discussed pricing oil in yuan for Chinese buyers and has joined the M-Bridge project, a central bank digital currency platform designed to facilitate cross-border payments without dollar intermediation. Russia and China have been settling bilateral trade in rubles and yuan since 2022. India is buying Russian oil in rupees. The Gulf states are diversifying reserves into gold, euros, and yuan at rates not seen in decades. This isn't rhetoric. This is observable capital reallocation by sovereign actors with multi-trillion-dollar balance sheets. When central banks shift even 5% of their reserves out of dollars, that's hundreds of billions of dollars of selling pressure. When energy exporters begin invoicing in alternative currencies, it reduces structural demand for dollars in global trade. The dollar's role as the world's reserve currency was never guaranteed by law. It was earned through depth, liquidity, rule of law, and network effects. Those advantages persist, but they are eroding at the margin, and in currency markets, the margin is everything. History offers a clear pattern here, and it's one that plays out across centuries and continents. Reserve currencies don't collapse overnight. They decline through a long, grinding process of fiscal overextension, monetary accommodation, geopolitical overreach, and the emergence of credible alternatives. The Spanish silver real dominated global trade for 200 years before giving way to the Dutch guilder in the 17th century. The guilder held sway until the British pound emerged as the world's dominant currency in the 19th century, backed by the Industrial Revolution, the Royal Navy, and the gold standard. Sterling's dominance lasted until the mid-20th century, eroded by 2 world wars, unsustainable imperial commitments, and the rise of the United States as the world's largest creditor and industrial power. The transition from pound to dollar wasn't instant. It took decades. Britain ran persistent current account deficits. It monetized war debts. It faced currency crises in 1931, 1949, 1967, and 1976. Each crisis chipped away at confidence. Each bailout, whether from the IMF or the US Treasury, came with conditions that diminished sovereignty. By the time the pound was fully dethroned, the process felt inevitable in hindsight, but contemporaries at each stage believed the system would stabilize, that Britain would muddle through, that sterling's role was too entrenched to fail. The dollar is now in the middle phase of a similar arc. The Bretton Woods system collapsed in 1971 when Nixon severed the gold peg. The petrodollar system, established in 1974, created a new source of structural demand, but it was always a political arrangement, not an economic inevitability. That arrangement is fraying. The post-Cold War unipolar moment, which reinforced dollar dominance through globalization and financial integration, is giving way to a multipolar world where regional powers are building parallel systems. The dollar remains dominant, but dominance is a relative concept. If your share of global reserves falls from 70% to 50% over 2 decades, you're still the largest, but the trajectory is clear. What makes this moment particularly dangerous is the speed at which conditions are deteriorating relative to the last major currency transition. The pound-to-dollar shift took 50 years. The conditions undermining the dollar, fiscal imbalances, geopolitical fragmentation, technological disruption through digital currencies, are compressing that timeline. We're seeing in 5 years what used to take 2 decades. Central banks are diversifying faster. Trade blocs are forming faster. Alternative payment rails are being built faster. The feedback loops are tighter. The information flows faster, and the optionality to exit dollar exposure is greater than at any point in history. Most people miss this because currency moves don't feel immediate in daily life. If you live in the United States, you buy groceries in dollars, pay rent in dollars, earn income in dollars. A weaker dollar shows up slowly, as higher prices for imported goods, as creeping inflation in travel costs, as a gradual erosion of purchasing power abroad. But for the rest of the world, dollar moves are visceral. Emerging market economies with dollar-denominated debt see their repayment costs fall, which sounds good until you realize it signals dollar weakness and often precedes capital flight. Exporters to the U.S. see their goods become more expensive in dollar terms, squeezing margins or forcing price hikes. Investors holding dollar assets see real returns erode when measured against baskets of commodities, foreign equities, or hard assets like gold. Gold, in fact, is telling the most honest story right now. It recently crossed $3,000 per ounce for the first time in history. And it's not because gold became more useful. It's because the opportunity cost of holding non-yielding assets like gold has collapsed as real interest rates fall and currency confidence wanes. Central banks added over 1,000 tons of gold to reserves in 2024 alone, the highest annual accumulation in decades. That's not speculation. That's institutional preparation for a world where the dollar's primacy is no longer assumed. The structure of global debt makes this particularly treacherous. There are roughly $13 trillion of dollar-denominated debt held outside the United States, much of it in emerging markets, and much of it reliant on rolling over short-term obligations. When the dollar was strong, that debt was expensive to service, creating deflationary pressure and default risk. Now, as the dollar weakens, servicing costs fall, but the signal is unsettling. A weak dollar often precedes a crisis of confidence, where creditors demand higher yields to compensate for currency risk, which tightens financial conditions globally, which slows growth, which circles back to pressure the dollar further. We've seen this movie before. In the late 1970s, the dollar collapsed amid stagflation, oil shocks, and a loss of confidence in U.S. economic management. Paul Volcker was brought in to restore credibility, and he did so by raising interest rates to 20%, triggering a brutal recession, mass unemployment, and a wave of defaults across Latin America. That was the cost of restoring dollar confidence. The question today is whether the political will exists to impose that kind of pain again, and the answer from both fiscal and monetary authorities appears to be no. The consensus now is to manage decline, to accommodate inflation, to hope that growth can outrun debt accumulation. History suggests that never works. The reason this cycle accelerates faster than previous ones is technology and connectivity. In the 1970s, moving capital across borders required phone calls, wire transfers, and days of settlement. Today, billions of dollars can move across continents in milliseconds. Algorithmic trading, decentralized finance, stablecoins, and real-time settlement systems mean that once a threshold is breached, once confidence tips, the velocity of capital flight can overwhelm traditional policy tools. Central banks can intervene in currency markets, but they have finite reserves. They can raise rates, but that craters growth. They can impose capital controls, but that destroys credibility and triggers exactly the panic they're trying to prevent. For real people, this plays out in ways that feel disconnected from financial markets but are deeply connected structurally. If you're a retiree living on a fixed income, a weaker dollar means imported goods cost more, travel abroad becomes prohibitively expensive, and the purchasing power of your savings erodes. If you're a worker in manufacturing, a weaker dollar might sound good for exports, but if your input costs rise faster than your wage growth, you lose. If you're a consumer reliant on electronics, pharmaceuticals, or energy, all of which have global supply chains priced in dollars, you see inflation at the checkout counter long before you see any benefit from export competitiveness. The common objection is that a weaker dollar is good for American exporters, that it rebalances trade, that it makes U.S. goods more competitive. That's true in a narrow, static sense, but it ignores the dynamic effects. A sustained dollar decline undermines confidence in U.S. assets, which raises borrowing costs, which increases the deficit, which accelerates the cycle. It also risks triggering a policy response from trade partners who don't want their currencies to appreciate too quickly. Competitive devaluation, where countries race to weaken their currencies to protect exports, was a hallmark of the 1930s and contributed to the collapse of global trade and the depth of the Great Depression. We're not there yet, but the incentives are aligning in that direction. Another objection is that the dollar has been declared dead many times before and always comes back. That's true, but it misunderstands the nature of reserve currency transitions. The dollar didn't replace sterling because of a single crisis. It replaced sterling because of a multi-decade accumulation of imbalances, wars, and the rise of a more credible alternative. The dollar is not going to zero tomorrow, but it is losing share, losing structural demand, and facing challenges that are qualitatively different from anything in the past 70 years. The rise of China as a creditor nation, the development of digital yuan infrastructure, the expansion of yuan swap lines, and the growing use of yuan in trade settlement represent a genuine alternative in a way that the euro or yen never did. What we're watching now is the convergence of fiscal, monetary, and geopolitical pressures that individually would be manageable but together create a cascade, deficits that require endless borrowing, a central bank that cannot tighten without breaking something, geopolitical rivals building alternative systems, technological infrastructure that accelerates capital flight, debt burdens that grow faster than the economy, and a political system that appears incapable of making hard choices. At this stage of the cycle, once these structural forces align, the question isn't whether the system adjusts. The question is, how violently? Orderly adjustments require trust, coordination, and policy credibility. Disorderly adjustments happen when one or more of those breaks down. A 4-year low in the dollar index, at a time when U.S. deficits are widening, when geopolitical rivals are building alternatives, and when central banks are accumulating gold at record rates, suggests we are closer to the disorderly path than most are willing to admit. The forward-looking implication is that we are transitioning from a world where dollar strength was the default assumption to a world where dollar stability is an open question. That transition will not be linear. There will be rallies, panics, interventions, and political theater. But the underlying trajectory is set by structure, not sentiment. The incentives are clear. The historical pattern is clear. What remains unclear is how long the adjustment takes and how much wealth is destroyed in the process. What is certain is that the conditions are no longer hypothetical. They are measurable, observable, and accelerating.